Hey everybody, Ben Gady here. And today we're talking about the all-in-one loan. And before we start, I need you to do something important. Forget everything you know about a 30-year mortgage. Yes, everything. Take it, crumple it up, throw it over your shoulder. If you actually just threw your phone, that's on you. Now, technically, this loan is 30 years, but that's basically where the similarities end. Saying this is like a 30-year mortgage because they're both 30 years is like saying a bicycle and a Ferrari are the same because they both have wheels. Come on. So what is it? Well, let's get into it. The all-in-one loan is basically what happens when your checking account, your savings account, and let's call it a home equity line of credit all move in together and decide to split rent. Crazy, right? So, part one, the HELOC, aka the giant credit card on your house. A home equity line of credit, or HELOC, is basically a big credit card attached to your home. Yes, a big one. As you pay it down, your available credit goes up, kind of like a responsible adult version of a credit card, but secured by the largest purchase of your life. No pressure. And here's the twist. Instead of a traditional principal and interest payment like a 30-year mortgage, this one separates the two. Yep, your payment is based on interest. Your income attacks the principal. It's like your paycheck shows up and says, "Where's the balance? I'd like a word." Part two, the checking account plot twist. Now, here is where things get spicy. Your checking account and the line of credit, they're linked. So when you get paid, that money doesn't just sit there waiting to buy coffee and Amazon packages. It immediately lowers your mortgage balance. Yes, immediately. Then, when you pay bills, the balance goes back up a bit, right? So your mortgage balance is basically doing yoga all month, up, down, wiggle, stretch. Now, why this matters? Because your interest is calculated on what you owe. That's why it matters. So when your paycheck lowers the balance, even temporarily, you're paying interest on a smaller number. Smaller number equals less interest. Less interest equals more money staying in your pocket. And here's the beautiful part. If your payment drops by, say, $200 because your balance is lower, most people don't just suddenly go, "Perfect, time to lease a llama." That extra $200 tends to just sit there, idle cash. And what does that do? It keeps pushing the balance down faster, which can potentially save tens to hundreds of thousands of dollars in interest over time. So, as we wrap up, no, it's not your typical mortgage. We've established that. It's more like your bank account and your mortgage decided to become best friends and aggressively tackle debt together. Beautiful, right? If you're curious whether this setup works for you, check the links below and schedule a time and we'll run numbers. And stay tuned because there's more coming that breaks down qualifications, costs, and even a simulator where you can compare the all-in-one loan to a traditional loan. Thanks for watching. Ben Gady signing off.